The Fed Reserve is putting all of its efforts into doing what it needs to do to keep inflation down, to control the inflation. Now, needless to say that Fed is even willing, and some might say it even wants, to see people suffer in its goal of full employment, if that is what it takes for inflation to go down. Because of this, every single piece of information about inflation seems important, hence the markets react. The Consumer Price Index or CPI report is the best way to know if prices are going up because it measures the real inflation. Other economic data, on the other hand, try to guess how much prices will change, which makes the CPI the most important economic indicator, taking the place of the PCE or personal consumption expenditure. The PCE is the Fed's favorite way to measure inflation, but it does not come out until the end of each month. The core CPI, which does not include the unpredictable costs of food and energy, is more important than the headline inflation rate. Politicians, economists are worried about how much gas costs at the pump, but the markets and the Federal Reserve are more worried about the inflation in general. Since the bank didn't start raising interest rates until the March of this year, the changes that happen every month are being looked at more closely than the changes that happen every year. So when it comes to the CPI data due tomorrow, 13th of October, what are we expecting? According to the economists, the core CPI month over month will rise by 0.5% in September, which is less than 0.6% rise seen in August. Still, this adds up to a nearly 6.6% annualized rise in the core CPI, which is more than 3 times the Fed's 2% goal and more than 6.3% year-over-year change seen in August. The Fed wants inflation to be 2%. I think economists have raised the expectations this time because they learned from the mistakes from the last month. They were wrong in thinking that the rate would be only 0.3%, wrong by twice by that amount. So are high expectations more likely to result in disappointment and as a result a decrease in the spending? We'll see. The Fed Reserve would like to see underlying inflation continue its descent towards 2% in a manner that is significant and sustainable. A level that is far lower is required for now. Of course, no one knows what CPI print comes out tomorrow on 13th of October. However, we can foresee 3 possible scenarios. Scenario number 1, we see expected CPI data. In this case, the core CPI month over month goes up by 0.5% or even just 0.4%. On the one hand, there's no upside surprise, which gives some hope that the Fed's price hikes and interest rates increases are coming to an end. On the other hand, even a change of 0.4% per month would mean an increase of 5% per year, which is too much by any measure. At this point, it is also higher than the lowest point of the year. Not to forget that the core CPI went up by 0.3% twice in 2022, so a 0.4% rise would still be significant. So the question is that in case of this scenario, what will happen in financial markets and the crypto market? I think the markets will breathe a sigh of relief and traders will cash in their profits on long positions in the dollar, but this will only be the first reaction. After the first instinctual reaction, a closer look at what the data actually show would show that at least some of the first reactions were wrong. Later, Fed Reserve officials are likely to say again that the more rate hikes are needed to fight inflation, which is still too high. Because of this, an outcome like this could give you a chance to buy dollars. It is the most likely to happen, and if it did, the predictions for a rate hike of 75 basis point increase in November wouldn't change much. Scenario number 2, lower than expected CPI data is what we see. I think that a lower than expected CPI data that is 0.3% or less would cause stock prices and Bitcoin to rise more and the value of the dollar to drop a more lot. The people in charge at the Fed would be happy with this outcome. Since it is in the middle of 2 less encouraging data points, it could be seen as a proof that 0.6% gain seen the month before was an isolated event. Also, the year-over-year rate would go down to 6.2%, which is less than August's 6.3%. Bond markets and Bitcoin will start to price in small increase of 50 basis points in November. Given that supply chains will need to be untangled and that higher interest rates will affect mortgage payments, this scenario is likely to happen somewhere in the middle. Scenario number 3, CPI data above expectations. A reading that is the same as or higher than the 0.6% rise seen the month before would be enough proof that the 0.3% rise seen in July was an outlier and that inflation is high. The financial markets would start talking again about a rate increase of 100 bips or 100 basis points in November. This would cause a rush to buy dollars and cause stock markets and crypto market to crash. Now, this scenario, and particularly one in which core CPI rises by 0.7%, would set off a frenzy of dollar buying and lead to a meltdown in stock and crypto market. Due to the many factors discussed above, I do not believe there is a high probability of this scenario happening. Nevertheless, it is impossible to completely eliminate the possibility of this scenario happening, and if this happens, it poses the greatest threats. So what are my final thoughts? We were all disappointed by the weak reaction to the non-farm payroll report, but the consumer price index, or the CPI, is considerably more significant, and the most recent 2 prints have caused volatility to surge. So be careful when you're trading, and if you're not sure what you're doing, do not trade at all around the time when the core CPI data will be announced tomorrow, 13th of October.